Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday.
This week, we'll have a look at the latest outcome of our Global Asset Allocation Committee. We'll have a look at the betting odds in the US with regards to the forthcoming US election. We'll have a look at some high-frequency data that suggests the global economy is slowing. And finally, we'll have a look at the turnaround at Eskom. We're going to start off with our Global Asset Allocation Committee. That committee met last week and decided to keep our allocations unchanged, our global allocations unchanged. The primary reason for the underweight in equities and US equities in particular is concern that the global economy is due to slow, the US economy is due to slow, and we don't feel that that's appropriately reflected in multiples. The US stock market, as an example, is trading on a forward PE above 20. So we remain underweight risk more broadly. We remain underweight the US. We are overweight equities in some jurisdictions, but in an aggregate picture, we're still risk off. We're overweight fixed income, the idea there being that as the global economy slows, fixed income should provide some protection. It's done so over the last month, so it's doing what it should. And that correlation between equities and fixed income, which has been so strong over the past couple of years, does look like it's starting to weaken. And fixed income is doing what it should do in an environment of slowdown, which is provide some insurance to portfolios. We still remain concerned that the dollar is likely to weaken over the medium term. It may well continue to be strong in an environment where the global economy slows and there's a pullback in equities, but the US dollar is still trading well above what we would consider to be fair value, and we expect the next few years is likely to be characterized by periods of dollar weakness. So broadly speaking, our picture remains unchanged. We are still cautiously positioned. We do expect to slow down, and as a result, within our portfolios, at the moment, we have a preference for insurance-type assets. Switching to the elections in the US, there's been a sizable shift. The betting odds now have Kamala Harris as the favorite. The market is implying about a 55% chance of Kamala Harris coming through versus a 45% chance of Trump coming through. So he's well behind at this point. There's still 3 months to go, and this could change quite a bit. The reason we're highlighting it now is A, the sizable shift over the past couple of weeks where she is now in front, but B, Kamala Harris is due to announce her policy platform, at least some key aspects of it, later this week, and we'll be able to start to do the sort of scenario analysis around what would imply for the economy and markets should either candidate come through, and we'll be doing more of that sort of work over the coming few weeks. Switching to global growth, PMI data has come out for all of the countries that we track. In aggregate, it suggests that there's been a continued slowdown of economic activity. The aggregate global PMI number at 52.5 is down on where it was last month and down on where it was the month before that too. It still is above 50, and still it's well above 50, suggesting that global growth is still positive at this point, but it is just slower than it has been over the past 2 months. If we look at individual countries, most of the countries that we track saw a decline in PMI readings, suggesting a high-frequency slowdown in growth in June in particular. But again, for most of these countries, the PMI readings are above 50. So we're not talking about a sudden recession anywhere in the globe that we're looking at. Instead, what we're talking about is a broad-based, continued marginal slowdown in economic growth. And if we zoom in on the US, the data shows, again, a very mild downtick in economic activity. The services PMI is still well above 50. There's a slight downtick for manufacturing. So we would expect a mild deceleration to become evident in the data as it becomes published over the coming few months, which again is consistent with a slowdown of sorts rather than a sudden recession. And we can confirm that idea by looking at export data from Southeast Asia, where again there's been a mild deceleration in aggregate for exports from China, South Korea, and Taiwan. So all pointing towards growth that is still okay-ish, but slowing, and ultimately we're starting to see the knock-on consequences of very high interest rates across developed markets and in the US in particular, and we would expect that to continue to be the case over the coming few months.
We hope you're finding this podcast valuable. If you are, please take a moment to rate Investec Focus Radio SA on your podcast platform. And to make sure you don't miss an episode, please remember to follow us.
Now, even though we expect a mild slowdown instead of a sudden recession, earnings forecasts still seem too optimistic for us. if you look, for example, at the PMI data, it suggests that earnings growth over the coming year should be 0% or maybe even slightly lower. The current consensus forecast is that earnings growth for most of next year will be double-digit, 10 to 15% up year on year. And that, for us, is concerning. We think that's largely in the market. That's why the US is on a forward P of 20, and we think that's where there's a sizable opportunity for some miss, and again, reason for caution at this point. Switching to China, there's quite a bit of evidence now that domestic demand is weakening. We'll get the total social finance numbers out this week, and we'll speak about it next week. But in the interim, there's just, as an example of some of the data suggesting the Chinese economy is slowing, if you look at the total number of visitors to Macau as an estimate of local domestic tourism, that continues to be low, and it's lower than pre-COVID levels. So there are a range of indicators suggesting domestic demand is weak. There is still scope for further stimulus, and we expect to see further stimulus from the Chinese authorities. If they attempt to spur growth in the way that they've done before, which is try to ramp up exports, they're likely to encounter greater tariffs. So they need to do more to encourage domestic demand. We haven't seen enough of that of late, and we would expect to see more of that in the coming few weeks. If they don't do that, then domestic demand is likely to continue to be weak in China. And finally, in South Africa, just having a look at the turnaround at Eskom, it is quite remarkable. The energy availability factor has been up to 70% now. That's the highest level in 4 years. And that's with more planned maintenance for this time of the year than we've seen in any of the last 4 years. So there's just much less unplanned outages. So it's been a remarkable turnaround, and what that implies is that Eskom is no longer the binding constraint on GDP growth that it was before. Now, there still are headwinds for the SA economy, if we think, for example, of water or even pricing for electricity. But this key constraint of electricity production appears to no longer be a binding constraint, and that allows for upside surprises for GDP growth. And the reason I'm emphasizing this is that growth forecasts for South Africa at the moment are very low. The IMF expects growth in South Africa to be in the bottom 15% of countries for the next 5 years in a row, consistent with the idea that Eskom would continue to be a binding constraint on growth. Now, as that constraint is eased, it allows for opportunities for South African growth to surprise on the upside. Even if growth is weak, the expectations would appear much weaker. And as a result, we remain optimistically positioned with regards to asset classes in South Africa, in contrast to our global position. In South Africa, in contrast to the rest of the globe, we see that valuation is not demanding, and we do see opportunities for beating expectations versus what we mentioned earlier on about the difficulties in meeting those expectations for earnings growth for the US. And that's where we're going to leave it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.